Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He says just about every market is setting record highs, led by the Russell 2000. Bitcoin has now become part of that soaring charge. What's better at predicting the markets, cycles or technicals? InsideTrackTrading.com President Eric Hadik tells us what he expects to happen with cycles governing the stock markets, gold, and currencies, while Chris Vermeulen from the Technical Traders tells us what he expects to happen using his guidelines to investing. They both take a look at major markets, gold, and commodities. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
And it's a pleasure to be back with you, Jim.
Ross, is there anything out there that isn't charging higher?
Well, let's put it this way. There's been a few that are still trying to gain some traction, but the ones that do have traction are just blowing out the lights here. We've got virtually every one of the indices in North America, at least, sitting at all-time highs. We've got the Russell small caps up 119% since the March low. They continue to be really the bellwether on the upside. NASDAQ's up about 93%, S&P 78%, and even Toronto, which had been a bit of a laggard, is still doing decently well, up 60% since March. Every one of these is new highs, and every one of them is starting to show extremes, as you would expect on the various indicators. But the trend is up, and that's the key. And when we take a look at the post-presidential years, that the key is the low that you put in, the lowest low between mid-December and the first week of January becomes a real critical support. And in 8 of the last post-election years, that low held right through February, and in most cases moved steadily higher. The 4 years that it broke, and that's what we have to be careful of here, were ones that went right back down and tested the October lows, usually around the level that had been seen at the time of the election. So the low that we put in here on January the 4th, just at the beginning of the week, that's the one as far as the U.S. indices, so the Russell, the Dow, the S&P. That's what we're going to be watching. And as far as the Russell's concerned, the advance off the low has a pattern we've been watching for the last, I guess it's about 3 or 4 weeks now. The advance here is more than that 85% level that has been really significant over the decades. And if we get a weekly pattern here that starts to roll over, and we're looking at the MACD, the Moving Average Convergence Divergence Index, if that rolls over and gives a sell, then we would expect to see the Russell drop probably in the vicinity of 15 to 20%. So we've got things to be on the lookout for, but trend is up. And for the ones that have got the momentum behind them, like Bitcoin, they are really on the move.
You had some interesting projections about Bitcoin, which gained 10 grand in 1 week.
Yeah, well, we 40,000 this week for Bitcoin. And when we look at the size of the consolidation under the high of 20,000 that occurred back in the end of 2017. If you look at the size, both of the width and the depth of that correction process, and compare that to what happened in the preceding stretch back in the 2013 through 2017 while it was consolidating, the style of those two consolidations is just an overlap of one another. And the various trend lines in terms of resistance that it has broken out of, and, you know, back in October, November, we said at that point that it looked as though it was ready for its next dramatic run. And the measurements out of those, we've done here a number of weeks ago, the upper target for Bitcoin, if everybody's sitting down, is 120,000. So, who knows if that's going to happen, but that's what the technicals say that the measurement will provide us right now. And at the pace that we're seeing with the increase in momentum this last few weeks, it wouldn't be a surprise.
What's going on with gold and silver?
Well, so this is now, we're now in, we've had 7 consecutive years where the rally out of the Christmas low, sort of around the 23rd, 24th of December through January, February, that has been done very, very well on the upside for 7 of the last 7 years. But historically, and we go all the way back to the early 1970s, only 60% of the time does that trade work. And it has never worked for more than 7 consecutive years. So this week, we had gold and silver move to new highs for, you know, taking out the levels that we've been seeing in December. It was looking pretty healthy into Monday, Tuesday, but then we got an outside reversal day. And middle of the week, it ran out of steam. And we were telling people, well, keep your stops really tight because the odds were against it just having continued upside momentum. Or say it could have upside momentum, but probably going to see a fair amount of chop within it if it did have the upside action. So anyway, 1900 was our line in the sand for gold. It broke that. And silver, I think at one point we were down about $2.50 on the day on Friday. So a big bit of action there. You want to make sure, you know, when you've got a position and you really have a conviction in it, the thing you really have to be careful of is having your stops in and preserving your capital, because if your trade's not right, you don't want to give back too much. And this one, 1900, appeared to be a decent stop area. Now, seasonally, if we take a look at it, it's not unusual to see the stretch right around the 8th to the 10th of January have a bit of a hiccup. And this one was fairly dramatic. We did end up with some capitulation signals when we look at the hourly charts of both gold and silver. So a bounce off this dramatic low that we had on Friday would be natural. We'll be looking, though, to see whether it has the capability of holding that low and putting on any upside. Now, the other part of the equation when it comes to gold and silver is to look at the U.S. dollar. And the dollar index had some capitulation readings back in December for us. And since then, while it has made marginally lower lows, the money flow indices, like the Chaikin and the demand index, were not confirming the downside action. They were showing some bullish divergences. And also when we look at our sequential models, those on a weekly and monthly basis were getting to points where you would anticipate a recovery rally. So for now, the end of the week had a decent reversal to the upside on the currency, and we would expect to see it retrace back close to its 20-week average and make back maybe half of the break that it had since the November 2nd high. So with a recovery like that in the dollar, it probably keeps a bit of a lid here on the precious metals for a while. And if the dollar can get up to its resistance levels, that's where one might want to once again look at being more aggressive on the precious metals and look for an interim low over there.
Ross, thank you so much for chatting with us.
Good to be with you, and remind everybody that the website has an opportunity there to take out a trial subscription for 2 months. If you'd like to take a look at our material, we'd be happy to have you on board.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at chartsbyross. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. Welcome back to the show, Eric, and Happy New Year.
Oh, thanks for having me back, Jim, and Happy New Year to you as well.
Eric, can you tell us a little bit about your newsletter and how people can subscribe to it?
Well, we have a couple different publications with different time frames as far as what traders are focused on and what they're trading. And in each case, it's a compilation of analysis and outlooks on specific financial futures markets and commodities, and also correlated indexes that cover a wide gamut of the market. We focus on technical and cyclical analysis, although certainly addressing some of the fundamentals, particularly when they are corroborating that outlook and how some of the technicals could even be kind of giving a little bit of hint or clues of what's coming in the fundamental realm. But it is very simply a publications with analysis and trading strategies for many of the primary markets.
The U.S. election is contested and corrupted. Can events like this cause market cycles to change?
Well, I would certainly, I don't discount the fact that very extreme events could certainly shift or delay or extend particular cycles, particularly those that are maybe coming to fruition at that time. But for the most part, I would say no. I think that often the events fulfill and validate and corroborate the cycles. And for instance, you often get, depending on the cycle, you'll get very different perceptions of events. You know, you look at the events of yesterday in the U.S. and the storming of the Capitol and some of the other events that have unfolded over the last couple of weeks. If we were in a down cycle in the market, each of those probably would have triggered very serious sell-offs that continued. Instead, we're in multiple phases of an upcycle, and so those type of events maybe trigger a quick pullback, a quick sell-off, but immediately the prevailing cycles take over, and it's as if nothing really happened. So that's one of the big things that I see as the distinction between how fundamental events are perceived and are reacted to depending on the cycles. And you even look at, some of your bigger events. Perfect example is earlier this year, last year. We're now in a new year. Earlier in 2020, I did a series of articles in late 2019, and then in January and early February, talking about how all the cycles, that there was just this perfect storm of long-term things as long as a 40-year cycle, down to monthly and weekly and even daily cycles, all signaling that the stock market should have a very sharp sell-off in February and March, and that many of those same cycles were telling investors to look for a major bottom in late March, even pinpointing the week of March 23rd to the 27th as a potential bottom. And so the cycles were already set up like that. It was discussed and documented for months beforehand, and then you get the reality of COVID-19 hitting the markets and all of the ramifications of that. And the market has this sharp sell-off from mid-February, and it bottomed on March 23rd, and that has been the major bottom in the market. So that fundamental event perfectly fulfilled what the cycles had been identifying for months before that event. So it's more often than not, it is some of these events just exacerbating or fulfilling or validating those cycles.
The Dow hit 31,000 points this week. What do you see ahead for the Dow?
My outlook has not changed since that late March low, and I keep saying this, and I'd say it again, that from that bottom, I thought we would see an overall advance into the second quarter of 2021. I'm looking at May 2021 as the time frame with the greatest synergy of weekly, monthly, yearly, longer-term cycles. As we get closer to that, I'm sure that shorter-term cycles will hone and probably shift the time for a precise intraday high, but the outlook all along has been that the markets would enter a new impulse wave advance in late March 2020 and continue moving higher with intervening sell-offs, obviously, into ideally May of 2021. So that has been the broad outlook, and nothing has changed that in my perception up to now. On a more intermediate, kind of 2 to 3 month basis, I put out a special report, a bridge publication on November 2nd. And in fact, in some of our previous interviews, I've offered it to your readers and or your listeners, and had a lot of them take me up on that offer. But this publication was called Equities and Extremes, the Surge 2 Target, and at the time, the stocks had, most of the indexes had been correcting since early September. They had spent September and October in a corrective period, and this report was saying that October 30th had fulfilled all the downside objectives, both price and timing, and that cycles were turning back up on November 2nd, and we should see a strong surge from there. And the point, or the reason that I bring that particular publication up, is that surge number 2 target that I discussed in there was, we were trading at about 26,500 in the Dow, and many of my indicators were telling me to look for a 2-month surge that would see the Dow spike above 31,000. And I detailed why I was looking at that level, why I thought that would be an extreme for the ensuing couple of months, and that once we got up there, we should see an initial peak. And so that's where we have the Dow now just spiking, been up to almost 31,200. And one of the primary levels that I described in that November 2nd publication was right around 31,300. So we are right there, and that's, key price objectives, but as things were unfolding in early November, I also discussed more immediate weekly and daily cycles, telling me to look for an initial rally into early December and an overall rally into the week of January 4th through the 8th, 2021, which is right where we find ourselves now. So the cycles that were looking for an overall up move into January 4th to the 8th and the price objective of the Dow surging above 31,000 in that two-month or so time period, both have been fulfilled. So I think that along with several other factors that are starting to come into play, I think we're very close to an intermediate top, and I don't see the next intermediate low, and I define intermediate as 2 to 4 weeks, potentially as big as 1 to 2 months. I don't think the next intermediate low will be till the end of January, so we could see some consolidation, some whipping back and forth from January 7th or 8th into January 28th, 29th, but with an overall downward slant. And then from there would be, depending on how, if and how that low is set in late January, that would be when I think we'd see the next move, perhaps the finale from there into May of this year.
The Russell 2000 went above 2,000 points this week in the bull market big picture. Do small cap stocks tend to move the most towards the end of a bull market run?
It depends on what the overall factors that are unfolding at that time. But one of the other things that I discussed in early November was that a lot of my indicators were telling me that the Russell 2000 and the S&P Midcap 400 were going to take over the lead in that surge that I thought we'd see from late October, early November into early January. That there were several indicators that were, particularly the S&P Midcap 400, that were turning very bullish. And so that's something that I have continued to stress over the last 2 months. And I think that you do often see things like that, and part of it has to do with the much broader multi-year economic cycle. And this was also something that I started discussing back in March of this year, March of 2020, at the same time that stock market cycles were bottoming in late March. There was also an uncanny web of cycles in silver that was pointing to a major bottom, and I also had put out some special reports on that, triggered a major buy signal when silver was trading around $12 an ounce. And one of the things that I concluded in those articles and those reports was that I thought, and let me step back one more time, there was one other major turning point at that time, and it was U.S. dollar cycles that were peaking in March, and I described how I thought the dollar should head lower into the first quarter of 2021 and drop from where it was at about 103 to at least 88, possibly dipping a little lower than that on the dollar index. Those three factors combined, the major low in stock market cycles, the major low in silver, and a top in the dollar, as well as what we were already starting to see, or at the time we were just starting to hear murmurs of, from a financial economic standpoint, I thought we would see an inflationary surge from late March of 2020 into the second quarter of 2021. And as that has begun to pick up steam and more investors start to become aware of it, and as it started to look like a Democratic administration was a stronger possibility, and with that, the perception that there would be even more government spending and stimulus in the first part of 2021, it all lent itself to supporting a lot of those smaller cap stocks, mid cap stocks, and starting to weigh on the expectations, any remaining upside expectations for tech stocks and others that had led the bull market the last few years. So there certainly was and continues to be a strong rationale for why the small caps and mid caps have taken over the mantle of market leader, and I think you'll see that continue to occur in the coming months.
How is gold looking short and longer term?
Gold, I believe, is getting closer to a multi-year cycle high. Now, with that, you also have to remember that most of gold's peaks, the final month of that, whatever rally preceded those peaks, often has a parabolic move higher. So just because, from a timing perspective, that I think we'll see a peak, and I'm also looking at that same time frame around April-May 2021. That's when I'm anticipating a final peak in the gold bull market that began in late 2015. So you could see a strong move to the upside leading into that. In the meantime, we have run up to some, we've been in an expanded period of congestion when you look at it on a monthly, weekly basis. When we started out 2020 and particularly once that silver bottom was signaled in March of 2020, I kept focusing my readers on two time frames for the overriding cycle in gold and silver. The first time frame was August, September of 2020, and the second was right around May of 2021. And I thought both of those cycles would time multi-month and multi-quarter peaks. From that time frame, looking forward from March of 2020, it wasn't 100% discernible whether the first one would be the penultimate top, and then the final one would be the ultimate top. In other words, ascending highs, or whether that August-September time would time a major peak, and maybe you'd see a double top in May of 2021. But most of the factors still show that that the second quarter of 2021 should see higher highs in metals. But as I said, in between, we're kind of in this long trading range. I described it as two peaks, the one in third quarter of 2020 and the other in second quarter of 2021, with a deep valley, a deep and drawn-out valley expected in between. And so that's where I think gold and silver are on a 3 to 6 month basis, that they've entered a wide trading range since the early October and early September highs, and that gold reached its initial downside target, which was at 1750 to 1770, but until it triggers a specific weekly trend signal that I have, and I've described this for my readers in more detail, but until it triggers that, it leaves open the possibility that gold could head back and retest those, that support around 1750 to 1770 and potentially even spike below it before the next, move up takes hold. So it's kind of in a very decisive time. The January 8th, weekly close price could reveal some very important clues based on specific technical indicators that I watch, and so that may even give some more clarity to the immediate outlook for gold and silver. But with how they just ran up to monthly resistance and some extreme levels that gold had at 1950 to 1962, and went right up there and is holding, I think you could see a decent sell-off from that level. And as I said, the January 8th closing price and then the action of next week will go a long way in determining what I expect for the next probably 1 to 2 months prior to when I think the next upsurge could really take hold.
Is silver likely to see a sharp pullback before heading significantly higher?
Silver continues to remain in a more bullish posture compared to gold, and when I make a statement like that, I'm talking about the technical structure that I see on the charts. Sometimes it may have a quicker, sharper pullback in price, or maybe the drop is even a little bit more percentage-wise than gold, but often it will remain in a more positive technical structure, which reinforces its future potential. And so far that remains the case in silver. And with my expectations that the first half of 2021 is going to see another inflationary move up, I think silver is still going to be the leader between the two metals, and that silver will see proportionately greater moves to the upside, and it too experienced a correction right to some critical support around $22. That really is the make or break point for me on a 1 to 2 month basis. So we did see a sharp sell-off from its early August peak down to there, and now it's more in a consolidation phase where it's determining how soon or not soon the next move up is ready to take hold.
What are you seeing in the gold and silver stock cycles?
The mining shares and the other related gold and silver stocks certainly run close to what the metals are doing, but they are almost as impacted by stock market cycles as they are gold cycles, and that's something that I think sometimes gold mining share traders lose sight of, that a gold stock is a gold stock. It's stock in a company. There's all the other things associated with that have no impact on the price of the actual metal. And so just because gold and silver are moving up or even down at a certain clip does not mean that the underlying shares are going to move at the same clip, sometimes not even close to that. Sometimes you'll have a correction in gold and silver where, because the stock market is continuing up, those gold and silver shares will remain resilient and even rally in the face of declining gold and silver prices, as long as gold and silver are kind of within a trading range and haven't entered any extreme up or down phase. So whereas I think that the cycles are similar, the XAU and the HUI index, the Gold Bugs index, they fulfilled some pretty significant monthly cycles back in early August. There's been a very consistent 47-month cycle, so just under 4-year cycle that was coming into play in August, which is why I thought we would see at least a 3 to 6 month peak then in the XAU index. But also in contrast to that, the first correction that that index saw, the gold silver index saw, was proportionally not as significant as what you saw in the metals because stocks were supporting it. So all that to say that I think the cycles run close to each other. It's often the magnitude of the moves in between that are more telling and more significant. And for that, that's where I rely on many price indicators, not the cycles. The cycles help me identify turning points and intervening or subsequent directions, but then it's price indicators that really need to hone that and give you more specific expectations. And so that's what I'm watching with the gold, silver stock cycles. Just one final point there on a kind of 1 to 2 month basis. The XAU index has just rallied right to critical support around 156 as we entered the month of January. Monthly resistance, which is also kind of a 1 to 2 week upside target for the beginning of any month. That was right around 155, 156, and what I call my weekly extreme upside target for the first week of January was at 155.48. So you have a very critical level right around 155 to 156 in the XAU that was expected to be reached, and we've just spiked above 156. But it also is, I also expect that level to hold, and it's what happens in the 3 to 5 days following that test that really will help determine whether the XAU drops down to its late November lows and even continues to move lower than that as part of this corrective cycle. So that's something that is yet to be determined, but it is certainly at a critical level in that 155, 156 in the XAU index. And so I think that that's the point where we really need to look for the next 1 to 2 month signals as for what to expect from the XAU.
We'll have more with Eric Hadik when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, is the U.S. dollar cycle likely to keep heading lower?
As I was kind of mentioning or alluding to in the discussion on gold and silver and on the inflationary cycles, I have been expecting the dollar to head lower into the first quarter of 2021 since cycles peaked in March of 2020. A bottom could even stretch into the first part of the second quarter. There's a myriad of monthly cycles and weekly cycles coming into play between February and May of this year, but then some of those weekly cycles are starting to hone that to a more specific and more tradable outlook. But I do think that the dollar is probably going to set a 6 to 12 month bottom in that time frame, perhaps something that could hold even longer than that, depending on where it is set. When you look at the dollar on a 5 to 10 year basis, it really had its major advance into 2017, and then from there you've seen what could just be an ABC correction, and by that I'm talking about that initial wave down from January of 2017 into January, February of 2018. Then you had the rally from February 2018 up into February, March of 2020, and all that did was take you back up to the peak that was set in early 2017. Now we're heading back down towards the low of 2018. So it's been like a big wide trading range where you see an initial decline, a rally back to the previous highs, now a decline that should at least reach those 2018 lows. And the key is going to be whether the dollar holds. I've got some other downside targets around 86.50 in the dollar index. So I'm looking at that 86.50 to 88 range as being a very determining factor from a price perspective of what to expect from the dollar looking out for a year or two after this expected cycle low in the coming months. So a lot of times the market, they will still adhere to these cycles, but they already start to give very important clues for what to expect following that. If the dollar were to hold right around 86.50 to 88 and then start to show signs of reversing higher, that price and wave structure would start to argue that the dollar could head all the way back up to those 2017 and 2020 peaks, and perhaps even rally above them. And in contrast to that, if this low spiked significantly below 86.50 and broke some longer term trends, it would still anticipate a bottom in this time frame. It would still anticipate a subsequent rally, but the expectations for that rally would be significantly different, and it would be more something where you expect it to rebound at least half of what that decline was, and then start to prepare for another decline. So that could have certainly major ramifications on everything from metals and inflation and even interest rates and stocks looking out on the 2 to 4 year time horizon. But right now it's a case of coming into these cycle lows and letting the market kind of reveal the more specific expectations for the next one or two phases of the overall cycle in the dollar.
Could we be in for interest rate surprises in 2021?
One of the things I keep describing since that discussion on inflation cycles and the dollar peaking and silver bottoming and stocks bottoming in March of 2020 is that, well, first of all, there was a extremely consistent and somewhat uncanny cycle in bonds and notes. It's been a very consistent 4-year cycle, and it has adhered to the cycle progression pattern and sequence that I described with one of my key indicators, where a market will set highs or lows at a particular interval, usually in the textbook scenario, and obviously the markets don't always trade according to the perfect theoretical textbook outlook. But in the textbook scenario, you'll have four successive highs, some of them higher highs, and then usually the last one being a bit lower high, before a cycle inverts, and then you see an entire wave during that cycle. So say we were talking about a 4-year cycle, instead of seeing 4 years between successive highs, the final one would be a 4-year downtrend. Then you would start to see a sequence of successive lows at that same cycle interval. And so what I'm getting at there is that throughout the 90s, the dollar, or excuse me, bonds and notes were setting lows at this 4-year cycle interval, and then just when it was time that you would expect an inversion, they rallied up into a important peak in the middle of 2008. Then you saw a subsequent highs in June-July period of 2012 and 2016, and it kept building my anticipation and what I was describing for my readers, that I thought we would see a major top in bonds and notes in the middle part of 2020. And from there, the whole paradigm would slowly start to shift. So from an interest rate perspective, that was where I was expecting to see the most bearish sentiment on interest rates, the most dire economic outlook, and certainly COVID and its ramifications, again, reinforced those cycles. Again, I'd say that's a 4-year cycle that was being discussed for 2 years prior to this to look for a major top in mid-2020, and all those fundamentals that really catapulted bonds and notes to new highs and the expectation for interest rates to new lows into mid-2020. That fundamental only became apparent in the final 6 months of that cycle. But I also stress to readers that just because you have a major cycle top like that doesn't mean that decades of declining interest rates are suddenly going to turn on a dime and you're going to see this suddenly surging interest rates. Instead, when you have a major top like that, it's kind of like changing direction of an aircraft carrier. You can, reverse the engines, but the actual movement, first it will start to slow, then it will come to a stop, then it will finally reverse direction. Even then, it's a very slow process until that reverse momentum really starts to build. And so that's what I expect from this next 4-year cycle for interest rates, that you'll slowly get the perception that, okay, interest rates have bottomed out. Now we're starting to get a little inflation. Now we're starting to get some economic recovery. So the expectations for anything lower in rates will dissipate and disappear. But the shift to expecting significant interest rate hikes will take quite a while before we get to that point. So we're in this major transition phase, and I do think that we probably will see some minor surprises in interest rates this year where that perception gets reinforced that, okay, rates there's not much more to do anyway in forcing them lower, but people might start talking, the economists might start talking about, okay, out in 22 or 23, we might see interest rates actually going up, and that starts to shift the current perception of things like bonds and notes. So I do think we'll probably see some small surprises, and I think that they will be somewhat price inflation driven, but I don't think you're going to see a major shift or major paradigm shift where interest rates are concerned just yet.
Where is crude oil in its seasonal cycle?
Well, from a seasonal cycle perspective, that is often hard to nail down because you will have things like OPEC and other fundamentals impacting oil prices at times that from a seasonal basis you might least expect it. Most recent example is, Saudi Arabia coming out just in the last few days and surprising the market and saying, okay, we're going to cut production through, I think it was February and March. But what my cycles have been showing, there's been some consistent about 4-month cycles in crude and an overriding much broader cycle, and all of them together were showing an initial surge into late August, early September, a second surge into early January, and then I'm looking for a third move up and expecting a peak in April or May of this year. And so right now, I'm thinking that the energy markets are getting close to a peak. I had some specific upside targets in crude that I've discussed for the last 2 months, and we're finally getting pretty close to them, as well as similar targets in unleaded gas and heating oil. So similar to stocks, you have both price and timing expectations being fulfilled and reaching fruition right during this January 4th to the 8th cycle high from a little bit broader perspective in the energy markets January 4th through the 15th, the first 2 trading weeks of the month and of the year, are the ideal time to see maybe a 1 to 2 month peak and some consolidation follow that. But then, as I said, I think you will see a third move up. Could begin as early as early February, because there are some intermediate cycles that bottom in early February. And so that could be the low from which the next move up takes hold. Doesn't mean that an immediate surge comes at that time, but when you're able to look back with 20/20 hindsight in a few months, it may be easy to pinpoint on the charts that, the correction in crude bottomed in early February. You saw a bit of a bottoming phase, and then new bullish factors began to take hold at whatever time frame, late February, early March. But I do think that the energy markets have another move up coming into April, May of this year.
Is natural gas coming off a seasonal high?
It's funny because a lot of people, I think, sometimes have either a misperception or a incomplete perception of natural gas. And you always hear talk about cold weather and the cold weather impact on natural gas, but many times it's the extreme heat, and you saw this in the third quarter of 2020, that forces certain electric plants and whatnot to now start to rely on natural gas as well to help generate the power that's needed. And so from a seasonal basis, natural gas has been showing a quite different type of seasonality than what the general, very basic expectation is that, you should see, a lot of times you have seen rallies into January or February, and that's the peak for the next year. My work was showing just the opposite last year, that we should see a major bottom in the first quarter of 2020. And as I described then, I thought that we were going to enter a multi-year bull market, and the first leg of that bull market should see a surge from the late first quarter of 2020 into November or December of 2020, and that's when you should see your first multi-month top and then your first correction from there. And natural gas surged right into the beginning of November, and then whipped around up near its highs for a while, and then has seen a correction since then. But it has actually fulfilled a lot of the intervening downside expectations. So I think that a secondary bottom is likely intact. And so my outlook is that natural gas is getting ready to head into its next 3 to 6, maybe 6 to 12 month advance. But just like I was speaking about with crude a minute ago, just because it bottomed right here, if I'm even correct on that, does not mean you immediately go into a major bull market and you're setting new highs in a couple of weeks. That's not how the markets work. It's not how cycles work. It's not how wave structure unfolds. It now is when you start to expect a bottoming phase. But again, if you look back in a few months, you may be able to pinpoint the late December, early January spike as being the final low of its correction, and when the second move up slowly began to take hold.
Bitcoin's been moving higher the past few months. What do you see ahead for Bitcoin?
Bitcoin is certainly a much tougher and more volatile one. I try to really, I put more emphasis and more confidence in the monthly and yearly cycles, even though I know it's, hasn't had that long of a history to give you a lot of yearly cycles. But one of the things that I wrote about in late 2018, early 2019. And this is a comparison, an analogy that I think is certainly coming to fruition. But I compared the action of Bitcoin when it had crashed down to $3,000. I compared that to the dot-com bubble and tech stocks, but on a much tighter time frame that you saw in 2000 to 2002. So you had a decade of tech stocks and dot-com stocks, first building up some upside momentum, then going into this just complete euphoric parabolic move up into the beginning of 2000, and then you saw an all-out crash, back down to multi-year lows into late 2002. But that did not alter the fact that tech stocks were the wave of the future. Many of them still would ultimately be viable options or replacements. Often the leaders are the ones that get slaughtered in the end and don't make it. And so that scenario where you saw the dot-com bubble, the implosion of the whole tech arena and indexes as far as their stock values, was just what you see during that phase of this type of cycle. It did not mean tech stocks were going away. It didn't mean that they wouldn't eventually set new highs and enter an even bigger move up. And so when I was writing in December 2018, January, February, March of 2019, I was describing the same thing in Bitcoin, but like I said, on a much more condensed time frame, that you had seen the bubble, you had seen this implosion, but it did not change the fact that digital currency and cryptocurrency was here to stay, and that ultimately you would see whatever the leading cryptos were move back up to new highs. Even a trend indicator, a monthly trend indicator that I follow. It's a lagging indicator. It is only used to identify major swing points and tell you whether the market has changed the major trend at those swing points or has been a major correction. And what I described in January 2019 was that the monthly trend indicator had not turned down in Bitcoin. So what that was showing was that the whole correction we had seen, the whole bubble bursting, was just the first phase of a much bigger move to the upside, and so that Bitcoin and cryptocurrency should begin a new wave higher, that you kind of had to flush out a lot of those Johnny-come-latelys that were buying it towards the initial top, and that's how markets operate. As Bitcoin went through its first surge into June of 2019, I reiterated what's been a pretty consistent 18-month cycle in Bitcoin's limited history, and it had helped time the December 2017 peak, and I was expecting an initial peak in June of 2019, and even as that was happening, I was focusing readers' attention to the end of 2020 as the next more significant cycle high. And so we're right in that time frame now. An 18-month cycle is usually treated as having about a 3 to 4 week window of range of error or swinging one way or the other. So we're right into that time frame where I think we are seeing a blow-off peak, but that doesn't mean that the whole multi-year bull market is over. It just means that, again, we're into this parabolic phase, and things have gotten ahead of themselves, and so at some point here, you're going to need to see a pretty sharp sell-off But I would never recommend trying to pick tops of a parabolic move up. That all of my price indicators have been very bullish since mid to late October, and so that still is what's in force. As a move like this unfolds, all I will do is identify where on a short-term basis you would start to signal a top, and Bitcoin has not done anything of that nature yet, so it's more a case of riding a surge like this, but trying to be as nimble as possible when that initial peak is signaled, unless you're just in it for the long haul.
Anything new on food shortages, and the agricultural cycles?
One of the things that I talked about throughout the last year and anticipating a big move up first in soybeans was this 4-year, 8-year, and 16-year cycle that soybeans have followed very closely, really dating back to the early 70s. That was the where this 16-year cycle that I discussed originated. And in 72, 73, you saw this major surge in soybeans where they tripled or quadrupled in price. Then 16 years later, 1988, you saw another major surge. 16 years later, in 2004, you saw a very similar surge. And then the breakdowns of that cycle on an 8-year basis, on a 4-year basis, after the 2004 surge and peak, you saw another big move up in 2012, 8 years later. And so all of those cycles, as well as an intervening 4-year cycle that saw some similar but not as strong action in 2016, all of them were telling me to look for a major move up in 2020, the second half of 2020. And so that's where we are in soybeans. And I think that they are actually, from a timing perspective, getting close to where we should see a multi-month peak. But at the same time, wheat is only beginning to show similar signals to what soybeans triggered back in July and August. And wheat has been in October, November, was starting to trigger similar signals. And obviously they are on different seasonalities, different supply and demand cycles, so that's to be expected. But the point is that I think that wheat is now in the early stages of what could be an accelerated move. I've already described some upside targets that I have my readers focused on, and some trading signals that were generated last month. So all of that is playing together, and I think that that wheat is going to see, on balance, a move higher into July of this year. But there are also some key intermediate cycles between now and then where I think you could see very important peaks along the way. But I do think that the wheat market is now the one that it's kind of like the soybeans handing the baton to wheat, where I think that that's now the next big grain market, or next grain market that could have a big move to the upside.
Eric, where can people subscribe to your newsletter?
The best place to go is to our primary website, InsideTrackTrading.com, and that inside is spelled with an extra I in the middle, so it's INSIIDE, TrackTrading.com, and contact us through the contact links there. You can also get a lot of examples, many archived reports, all the things that I have referenced here. We have archived there the Bitcoin articles back in early 2019, the silver and stock discussions of March 2020. So there's plenty of examples and samples that they can read through there and just get a feel for our approach to the markets and whether that's something that would fit with each individual's specific approach. So that's the best way to get hold of us.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. He was speaking to us from the Chicago area. Coming up, Chris Vermeulen, next on This Week in Money.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Chris Vermeulen from the technicaltraders.com. Chris, Happy New Year. And before we get going, can you tell us a bit about the Technical Traders?
Sure, yeah. Happy New Year to you, Jim. The Technical Traders, well, I focus purely on the technicals of the chart. So I focus on chart patterns, price action, cycles. I keep pretty much fundamentals and news out of my analysis and trading, and it really saves a lot of time and kind of streamlines the analysis. Takes a lot of emotions out of the market when you're just following price and trends. So that is the main focus of what I do. And the way I kind of tweak things is I follow the best asset now. I call it the band trading strategy, and I use relative strength. So I'm always looking to be in the strongest asset, whether it's a commodity or a sector. I trade ETFs, and we try and find the leading sectors and ride those up. Last year, amazing year. This year is going to be another wild sector rotation-driven market, which is great for trading. So excited there.
The U.S. election is contested and corrupted. Should we be expecting extreme volatility in the markets during this period of time?
For sure. Volatility, it depends on how you look at it. So a lot of people think when they see volatility, they think the VIX rising and the price falling. The way I like to look at volatility is just what price is doing. So this week, we had a lot going on with the Biden administration moving in and what was happening in Washington and D.C. So we saw some big price volatility just in terms of price swings. We didn't really get any sell-offs, but we're seeing big intraday moves to the upside. We're seeing some to the downside. So I think we're going to see increased volatility, but it doesn't mean the market's going to fall down and collapse. It means we're going to see big swings, and the market could very easily continue to move higher.
The Dow hit 31,000 points this week. Are you seeing any indications in the charts of where the Dow is likely headed short and longer term?
Yeah, the Dow has had a really nice chart pattern, really strong move. The next level for the Dow is going to be around the 3,108 level, or the 31,800 would be the next kind of stop from where it is right now, where it's on its move there. I think looking forward a few months from now, several months, I think we could see it reach 33,000 going forward. So I think there's a lot of upside potential. The Dow's really starting to come to life, along with the Russell 2000 and the Transportation Index. All three of those, when they're moving together, is a sign that we're seeing economic strength, or at least we are in terms of investors are expecting economic strength to come around the corner. So this is a really bullish sign for the market and the economy, because it's pointing to the big money is going and betting on a better economy, 12 months from now.
How is gold looking short and long term?
Gold continues to have a really strong chart pattern. The bias is to the upside. It's in a bull market. The patterns are pointing to higher prices. And if we do continue to see this move that has been forming in gold over the last year, we could see $2,400 gold sometime later this year. So there's a lot of upside potential, I think, for gold going forward. And obviously, right now we're seeing a wave of money with the Biden administration moving in. That money seems to be moving into economic stocks, and it's kind of coming out of the defensive plays like utilities and gold and in gold miners short term. But I do think long-term picture for precious metals with stimulus, printing, all those taking into effect a depreciation in the currency is going to be good for metals.
Are we likely to see higher highs in 2021 exceeding gold's 2020 top?
I think we will. I think the 2100 level where gold almost got up to there, I think we'll break that. I think 2400 could be a pretty big stretch to the upside. That's definitely the maximum target I have for this year, but I think we will break the 2020 highs.
How is silver looking short and longer term?
I like silver a lot. Silver is actually a much stronger chart pattern than gold. Silver's recovered very well. It is showing a lot of signs of leadership, where we're seeing some days the silver and the silver miner stocks are some of the strongest moving days or sectors in the market. So we are seeing big money move into the silver. I think a lot of people are primed and ready for metals to break to the upside, and the best leverage you can get out of it is silver and the silver miners. So that is definitely showing signs where there's some big money moving into that sector. Again, it's pointing to roughly $58 an ounce on silver if this pattern that plays out actually completes. So really exciting potential there.
So you expect silver could top its old record of $50?
I do, yeah. This chart pattern is a very strong one, and we're showing really nice signs of leadership. It's becoming one of the best assets now, and when it does break, it is going to have a massive run. I think it's going to catch the general mass investor off guard. It's going to happen very quickly, but you can definitely see there's money in the background moving into this sector expecting a big move, and yeah, 58 is the upside target.
Silver put in an outside year to the upside in 2020. Is this a bullish sign for silver in 2021?
Yeah, the outside year, I mean, very strong move for silver. It's pointing to, again, much higher prices going forward. When you have a big reversal like that, especially after seeing silver consolidate in a bottoming formation for 5 or 6 years, to have a nice clean break like this is a very good sign that there's a lot of momentum behind it, and we should continue to see this move higher. So 2021 should be a good year for silver. And it could be very parabolic if it gets the traction that I think it could get here.
How are the miners' indexes looking as we start off 2021?
The gold miners are underperforming a little bit in terms of when you relate them to the silver miners. Now, they both look very strong. They have a very strong pattern for long-term play this year. I think they could become one of the leading sectors. They are not one just yet, but the gold miners could be explosive and have a very strong move in the first quarter of 2021. They're just starting to get some traction. Gold miners are underperforming a bit. When you look at the silver miners, like the SILJ, which are the junior silver miners, it's already broken out to a new upside leg, and it's showing roughly 50% upside in this ETF alone to the next target. So there's a lot of upside in the miners. Silver miners, to me, is the place to be if you're getting involved in that.
What's happening with platinum and palladium?
Well, platinum's pretty exciting, actually. If you were to look at the monthly chart over the last few years, there's a very clean line that it's been stuck in a bottoming formation. It's been trying to build a base. And December 31st, when the market closed there, it actually broke out and it held up for a month above that breakout level. And so technically, January 1st, or the first trading day in January, is actually a new bull market, a new buy signal for platinum. So very exciting what's going on platinum. We saw gold break out in 2019 of a very similar base, and then we saw silver break out in 2020. Here we are in 2021. Platinum is the fresh breakout in the precious metals sector. So you should be pretty excited. It's a pretty interesting play. It should have a lot of power here for at least a few months, if not for the whole year. It's got a lot of upside target. Next target is around $1,400 an ounce. It's currently trading at $1,100, so there's some pretty good upside there.
The U.S. dollar's been in a downtrend since March. Is there any sign of the U.S. dollar bottoming?
Well, the U.S. dollar, it's definitely been struggling. I do think it's going to find some support almost where it is right now. I mean, when we look at the U.S. dollar, the Dixie index, it's trading down at 89.75. This is a long-term kind of support zone. I think we're going to see it bounce for a little while. I don't think it's going to have any big rally. I think it is a kind of a dying currency at this point. Eventually, it's going to, I think, break down even more and trigger a very big move in precious metals. But I do think most of the downside over the next month or two is probably done. It's going to try to stabilize, and when it breaks down in a month or two from now, that's when I think it's going to have a big drop again, and we're going to see metals actually have that big pop and miners become a leading sector.
In 2020, the U.S. dollar put in an outside year to the downside. Is this likely to be signaling a bullish or bearish 2021 for the dollar?
Yeah, the U.S. dollar, definitely a big reversal to the downside. It's a bearish sign. We saw this happen several years ago. We saw it happen in 2002 as well. It's pointing to much lower prices for the dollar. Again, longer term, I'm bearish on the dollar, very bullish on the metals. So I think people who are looking to own currencies, the U.S. dollar, I don't think is the one you want to be in. Probably want to be potentially in the loonie, the Canadian dollar, going forward.
How is the Canadian dollar doing?
The Canadian dollar has been doing pretty well since the March lows last year. We've seen the Canadian dollar really muscle its way up. It went from 0.68 all the way to 0.78, so a very big move to the upside. Again, investors are piling into economic stocks. They're moving into energy, and crude oil is rallying, and we usually see the Canadian dollar move very close to what crude oil prices are doing. So if we are on the upswing here, we had a bear market last year, we're on a new bull market. That's a very strong sign for the Canadian dollar, and it could have put in a major multi-year low and could rally substantially. So I'm definitely bullish on the Canadian dollar, bearish on the USD.
We'll have more with Chris Vermeulen when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Chris Vermeulen. Chris, Bitcoin recently has had a great run. How are the Bitcoin charts looking?
Yeah, Bitcoin is absolutely going parabolic. It's just on fire, and it's just on this tear to the upside. Who knows where the top is? You do not want to bet against something going straight up. It is showing signs. It's showing signs on the chart to me that show that it's a kind of a euphoric phase. A couple of weeks ago, we saw a big gap up in Bitcoin one day, and then it rallied higher, and then a few days later had another huge gap up, and then rallied higher to where we are now. And when you start to see these gaps, I call them exhaustion gaps. It just means it's growing at a stage where price is just jumping in price by leaps and bounds and creating these gaps. And when something goes straight up, you got to be really aware. Eventually, it's most likely going to come straight back down. When? I don't know. You don't ever want to try to pick a top in a bubble or in a euphoric stage like this, because we could see $50,000, $60,000, $70,000 Bitcoin for all we know. But when it does start to reverse and form some topping formation, it's going to be an interesting play to the downside. Right now, if you're long Bitcoin, I mean, you got to stay long. This is a rocket ship, and I would just be moving protective stops up in those positions you have, so that if it does have a big red bar, or a few of them, you can actually lock in some gains. But it's an amazing ride. It is still going higher, and it's just incredible what it's doing.
How are the charts looking for crude?
I like the crude oil chart. I think you and I actually spoke several weeks ago, actually a couple of months ago. I was talking about how we've got an upside target around $62 to $64 it was the upside move for crude if it could break the highs that we saw back in August. And it broke out from there, and so it's working its way up. Again, money is moving into the energy sector. People are expecting that we're going to have transportation open up and things are going to get better, which I'm sure they will eventually. And so that's where money's going. Crude oil is got a big move from where it is right now. Currently trading at $51 a barrel on the continuous contract, and I think it could go all the way to the $64. So there's a lot of upside potential in crude, and that's good for the economy.
How is natural gas looking?
Natural gas has had a very rough ride. It's putting in a multi-year basing low. So every 4 years or so, we see a major cycle low in natural gas. And we saw that in early 2020. We had that 4-year cycle low. It's had a very strong and choppy ride to start to move higher. I am bullish still on natural gas. I think we could see it go all the way back up to the mid $3 mark, potentially all the way to the $4.50 mark. So there's a potential there for almost an 80-90% gain from where it is. But it's a very tough asset to trade. If you're an ETF trader, you really don't have an option. There's some ETFs around it, but tough to trade. Overall, it's forming a bull flag. If it can start to break above $2.80 on the continuous contract, we should start to see this run back up to the $3.75 mark. It'll be a pretty significant run. So I'm bullish on it, but it's a tough one to trade.
What are you seeing for interest rates and the bond market?
Yeah, the bond market has been beat up pretty bad. It's been trying to find some traction and move higher, but it just continues to move sharply lower. This week it had a big collapse in price, and there's just not a lot of faith in it, and rates are going to stay low, and people don't want to own bonds right now. They are moving into growth stocks. So that's just kind of the bias is out of the defensive plays, out of utilities, bonds. Right now, short-term people are moving out of gold in miners, but bonds I think are kind of dead money at this point. When they start closing above the 50-day moving average, like the TLT, which is like a 20-year plus bond market, when it closes above the 50-day moving average, that'll be a sign that, hey, there's actually a new uptrend in place. There's some fear creeping in. People are starting to buy some protection in these defensive assets. But right now, you just want to steer clear of bonds.
What is more important in investing, charts or fundamentals?
That's a good debate, but I would definitely say charts are really the only thing that matters because I see it all the time. You have a beautiful chart pattern and terrible news comes out and the stock still goes up. Or you get good fundamental news and the stock collapses. There's no real connection to, in my opinion, in trading fundamentals. Now, obviously, when we're in a strong bull market, you want to go looking for stocks that have strong fundamentals, and then if they're performing very well, those are the ones you definitely want to focus on, a nice hybrid of those. But really, the only way we make money as traders is if the stock price moves in our favor. So I don't hold my breath for earnings. I don't hold my breath for news or fundamentals at all. I just follow the charts. Typically, when a chart is pointing in a direction, it means there's probably going to be good fundamental news coming down the road, and that's why it's pricing it in. So that's how I kind of look at the fundamentals as a lagging indicator.
What is the biggest market win you've ever had?
Ooh, that's a good question. It would have been a penny stock in the mining sector several years ago. I think it was a relatively small position that it went from a couple $1,000s into the position, and it turned into $127,000 in a few days. That was my biggest win, and that was back in 2009, I think. That was like a biggest individual little trade win. That was just one of those trades you put on as a penny stock. You're like, yeah, if this thing ever took off, it'd be amazing, and then it did. But other than that, it's I don't do huge, massive positions and look for those big gains. I play very conservatively. I don't put a lot into positions. I don't do a whole lot with penny stocks anymore. It's not my style.
Where can people follow you and find out more about your subscription service?
Sure, yeah. Well, they can visit my website at thetechnicaltraders.com. And I'm actually teaching my band strategy in a webinar this coming week. So anyone can go to the webpage. You'll see a webinar registration. And it's a 1 hour, 100% education. I actually walk you through a strategy and learn some very interesting analysis, how to spot leading sectors, how to time your entry, how to manage each position, when to take your targets, when to get out. And so I'm teaching that next week. It's really exciting stuff. It's based around technical analysis, momentum, relative strength, and that's our core focus at the Technical Traders. Of course, we provide trading newsletters where we give you our best asset now ETF trades that you can follow, but we also teach you for free on our webinar at the website.
Chris, thank you so much for being on This Week in Money.
Hey, thanks for having me, Jim. Always a pleasure.
My guest has been Chris Vermeulen from thetechnicaltraders.com. If you have any questions for Chris or any of the other guests we've had on the show today, you can send them to info@howstreet.com. We'd like to thank our guests, Ross Clark, Eric Hadik, and Chris Vermeulen, and thank you for listening. We'd also like to thank our sponsors, American Manganese, Aben Resources, Engineer Gold Mines, and Golden Arrow Resources. Now stand by for a company showcase update from American Manganese President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry, and Happy New Year.
Well, a very Happy New Year to you, Jim, and it's starting out very well for us.
On Tuesday, you had a news release. Can you tell us about it?
Yeah, that's a news release that really should have propelled the stock, but it's very important, that we had a peer review, and that peer review was out of the Journal of the Electrochemical Society, JES, and we're getting some of the metrics back on that by Altmetric, and they've tracked 16.5 million research outputs across sources so far. And they say compared to these, this one has done particularly well, and it is in the 93rd percentile, in the top 10% of all research outputs ever tracked. That means there's a lot of interest in what we're doing, and we have to give a big thank you to Cometco, with Joy Jung heading up this research paper. And with Norm and all the crew at Cometco contributing, it was a stellar success, is all I can say. As I just said, during the top 10%, and that's out of 16 million that they have tracked. And so that'll be attached to the news release, and it's peer reviewed. I can imagine that a lot of companies will start taking us seriously over this, and that's what we're hoping for, that some of the big battery manufacturers or EV manufacturers or other people in the arena will start to, stop doing due diligence and maybe start talking turkey, but we'll have to wait and see on that one. But I couldn't be happier about that. And also, Zarko was included on that research report, our CTO. So that's a big star in our hat for Amy's contribution. And Jim, I can't say more about that. That is probably, we've had deals with two departments in the Department of Defense and the Department of Energy in the U.S. We've had grants from from them, and we've also had Canadian grants, but this is the one that I think that puts us over the top, and people should start paying attention to this. It's you won't see many other peer-reviewed papers out there because there's when it comes to recycling, you may see some, but we don't know enough about those competitors out there to make a solid remark on that. So I'm really happy about that. We've also included a article that was produced by the Globe and Mail on Stockwatch, and it talked about the increasing number of short bets on the TSE exchange, the big exchange. And Barrick has rose up almost to 25%, and that was at 14.9 a half a month before. So if you could get these things, you'd know what the price of gold was going to do, because gold is the most manipulated commodity out there, and certainly it's down, it's over $80 down when I last looked, and that's got something to do with the election and everything else. And the election is really important to us, but it also talks about Newmont, short positions in Kinross, other companies out there that are on the big board. And so it's not just me whining in the corner about short positions in our stock, which are still pretty huge. And but I think a lot of our birds are coming home to roost. And the reason I talk about short positions, if everybody decided to contact IROC and demand that they stop stealing billions of dollars from not IROC itself, but the fact that we have no uptick rule or short rule, billions of dollars, tens of billions of dollars have been lost in the last 10 years, but lost to investors in trading Canadian shares. So that should that would help get the uptick rule reinstated, and I think we'd be off to the races. But we'll get off to the races anyway by doing diligent work, a lot of transparency in what we're doing, and so it shouldn't be any surprise that we would end up with a peer review. And these things are things that help companies through the chute. Now let's talk about the election briefly. Certainly the election promises, and the results with Biden promises a lot more input into the EV car and manufacturing and the battery manufacturing and the recycling, and that's got to be good for the company. I said that earlier. It wouldn't matter who got in, that that we would thrive in that atmosphere. So it's been a great beginning of the year. We're still trying to play catch up with a lot of things that happened or are happening after the holidays, and so it's next year we get next week we'll get down to the business of testing material and getting our recycling back up in full operation. So it's all good, Jim. I mean, I can't say any more. I'm kind of stuck on saying things because I'm excited, and I'm excited about the fact that we should be doing very well. Although we're trading at 49.50 cents right now, that's not a big detour from where we were trading before. We're still trading in the millions of shares a day, and hey, it's all good. It's just a fantastic year starting out for us, and I hope that this continues for everybody, not just us. And but unfortunately, gold got hammered down by $80 the last time I looked today, and silver down over $2. So these things are not that great. But I'd like to just mention that the barometer for metal markets is copper, and it's still way up there, trading close to 8-year highs, and which is exciting considering the spin-out that we want to do. And we should be moving ahead on that now with bureaucrats and law firms back at full force. So, yeah, I can't say more. I mean, we'll have news on the Manganese project. So that, we had shipped the project late last year. It's been received by Cometco, and I'll be reporting on that as we progress. So I expect another huge amount of press releases and updates on the podcast over the coming year, or over this year now. It's not the coming year, over this year. And hey, we're in an exciting place right now.
Larry, for people new to American Manganese, what's the company all about?
The company is a critical metals company that developed the process for treating low-grade ores of manganese in the U.S., and you can't make steel without manganese, so that gives you the importance of that, as well as the battery importance. And we patented that process in 2012. That was the cornerstone of our recycling process. And we've got 2 patents on that, and we're moving ahead with that. We've spent probably $7 million on developing this process. And it may be more, it may be a little less, but $7 million is a pretty good number. And, we spent more than that on the original process back in 2009, 10, 11. So, this is a company that is highlighting its critical metals, and our critical metals for batteries and the recycling are very important.
Larry, where are you traded, and where can people get more information?
We're traded on the Toronto Stock Exchange Venture under the symbol AMY. We're traded in the U.S. under the symbol AMYZF. We're traded in Frankfurt under the symbol 2AM. You can find all the information you want, because we have been very transparent about what we do, that people should be going to the site. And instead of sending us long emails on stuff that we've already reported on, that takes away from actually moving the company forward. So that's at AmericanManganeseInc.com. We're traded on, I've already mentioned that, where you can contact the company at LREAUGH@AMYMN.com, or give us a call at 778-574-4444.
Larry, thank you so much for the update.
You're welcome, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. Our conversation took place on January 8th. I'm Jim Goddard.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.